You know, everyone has been so focused on the tech rally we've seen. The question I was wondering is, do you think that this is retail-led? And I say that because we didn't see that bid higher for treasuries, which normally would do when it's really much so investment money. We'd see that rotation from risk-off into havens.
Well, we certainly saw a lot of retail money basically chase that tech trade. So it could very well be that a lot of retail investors got a little spooked by the story regarding the option buying, and that they all of a sudden felt that maybe a 44 multiple on certain companies like Apple was a bit rich. So I wouldn't be surprised if there was a little profit taking from that group. Mind you, there's still a lot of money that has been made year to date. So for these people, maybe 40% up is enough for them for now while they reassess and see how this story plays out.
Wouter, good morning. It's Manus. That's what I sort of wanted to get a sense from you. Anne-Marie and I have been looking at a whole variety of people through the week. Gundlach saying we're in nosebleed territory. Goldman saying still they want to throw their hat in the ring for tech. And Deutsche Bank were the most overvalued since 1800. Does it make more sense when you see the VIX at elevated levels to scale back in terms of overall equity exposure and look perhaps for better opportunities, buy the dip, that awful cliche, but everybody was using it about yesterday? That's what we saw. Is that what's at play?
Well, that's the dynamic now, I think, that a lot of investors will need to wrap their head around. Is this a temporary spike in the VIX? In which case you could, of course, argue that if you believe that the economy is going to continue to recover, and if you believe that support, both fiscal and monetary, is going to stay in place, that you should buy the dip because the VIX will come back down and you will have a buying opportunity here at a more attractive level. If, however, you believe that maybe the VIX will stay higher for a longer time, then you need to start thinking about a new, what we call, volatility regime. And that, of course, would imply lower valuation levels on things like equity, but also credit and high yield would need to be reassessed, because a higher VIX level, a higher level of volatility does mean a higher level of underlying risk. And I think that's the question that we're now facing. And to be honest, we're still in the middle of that. We don't think it's either or at the moment. We don't have enough evidence yet, but clearly we should be prepared for a prolonged period of higher volatility, just given the Brexit, the elections, and the US-China trade conflict that are still right in front of us.
Yes, certainly. There's going to be more volatility as the weeks progress. I have a question about bonds. In a world where just central banks rule, is it really safe to put your money in bonds? And if not bonds, where do you search for safety?
We've seen people search for safety in a couple of places. Gold, of course, is one of them. I think the question on bonds is really, what do you expect when it comes to inflation and perhaps curve steepening on the back of inflation expectations moving higher? At the moment, we feel that there's still so much demand shortfall that the inflationary threat is really quite limited. But we're also acknowledging that the inflation story in the future might get challenged by all the support that's coming through from the monetary and fiscal side. So if I was a bond investor, I would firmly expect the short end of the curve to stay anchored, because central banks are not going to hike rates anytime soon. But that long end of the curve, that's where the inflationary expectations start to play a bigger role. That's where I would focus my attention in terms of being a little bit more careful with my positioning.